This video is sponsored by Finimize. In this day and age, we all know that we should be working smarter, getting our money to work for us. But if you're anything like me, that seems like a lot of time and a pretty long-term commitment. So how can we keep up with what's happening in the world of investing? Or more basically, where do you start if you're completely new to the world of investing? Well, today's video is sponsored by Finimize, and they can really help you with that. Finimize is an app that was designed particularly with young, busy people in mind. The idea is to give you the information and tools you need to invest with confidence and eventually empower you to become your own financial advisor. We've been playing around with it for a couple of days, so let me share with you a few features. So, as you'd expect, they have the financial news packaged in the daily brief. And here you have the option of text or audio summaries that you could easily digest on your commute or whilst you're walking the dog. But when you actually want to go even deeper, they also have these 100 plus packs. I know that research was often a stumbling block for me. It's just so time consuming. But with these packs, you really get a comprehensive outline of top industries or companies that you may be looking at. Another thing that I liked was the chat function, where you can ask questions to others in the Finimize community. And once you find your feet, there are Q&A sessions with investing pros and analysts too. In a nutshell, Finimize brings the biggest financial news and professional insights to young investors in language people can actually understand. That demystifying approach carries over into the user experience as well. I found their design really good and uncluttered. Overall, it's a great tool, providing easy to digest investing knowledge. Click on the link in the description to set yourself up with a free 7-day trial, so you can see for yourself. And remember that you can cancel at any time, even with the completely free 7-day trial. And if you do want to subscribe, all VisualPolitik viewers will also get a 20% off the premium yearly subscription. So check it out, Finimize. And now, let's get into our video. Sometimes miracles really do exist, even in the cold hard world of economics. Look at what happened in Japan after the Second World War. For almost 20 years, between 1955 and 1973, the Japanese economy grew at an annual average of 9%, and that wasn't all. For most of the following 2 decades, from 1973 to 1990, average annual economic growth was over 4%. It was what became known as the Japanese economic miracle. In barely 3 decades, Japan went from being a war-torn country to becoming an industrial and financial powerhouse, the largest international creditor and one of the richest countries on the planet. The factories were working on a piecework basis. The Japanese did not know what it was like to be unemployed, and the savings of families and companies just kept growing. In the 80s, Japanese companies were the great technological benchmark. It wasn't difficult to see that their domination over the electronics industry was overwhelming. The VHS players, the pocket radios, the cameras, the video game industry, the Walkman. Virtually all advances in consumer electronics and almost all the major fashion companies were located in Japan. The feeling of prosperity was so intense that at the time, forecasts indicated that sooner or later, the Japanese economy would even outgrow the economy of the United States. Japan was destined to become the world's largest economic power. But as we all know, that never happened. The prediction, as so often happens, simply remained just that. A prediction. The reality was very different. In 1990, a huge economic and financial crisis broke out, from which the country, even today, 30 years later, still has not fully recovered. But what exactly happened? How did the Japanese miracle give way to decades of economic crisis and stagnation? What was it that created one of the biggest bubbles in history? To answer these questions, we have to go all the way back to 1985.
The Plaza Accord.
During the first 5 years of the 1980s, the US dollar appreciated by 50% against the Japanese yen, the German mark, the French franc, and the British pound. This made US exports more expensive and imports cheaper, which caused the trade deficit to climb to 3.5% of the US gross domestic product. The result was that, for the first time since the end of World War I, the United States became a country in debt to the rest of the world. This fact, together with the difficulty of large American companies to sell their products abroad, became the main political and economic concern of the time. Now, what does all this have to do with what happened in Japan? Well, it's quite simple. Pressure from the United States led the finance ministers and central bank governors of the 5 most industrialized companies in the world at the time, the G5, United States, Japan, the United Kingdom, Germany, and France, to make an agreement at a meeting held at the Plaza Hotel in New York to intervene in the foreign exchange market in order to devalue the dollar. And devalue they did. Look, for example, at what happened to the yen's value against the dollar. In just a few months, the dollar depreciated by 50% against the yen, which obviously put a strain on the Japanese export machine. After all, the United States was by far the Japanese industry's largest customer. At least 40% of all Japanese exports went to US consumers. Well, the fact is that these Plaza agreements were a real turning point. It was at this point that a huge financial bubble began to develop that would wipe Japan's prosperity away 5 years later. Pay attention to the 2 main players in this whole story.
Panic in the Japanese government.
The Central Bank of Japan. Behind its doors, many of the decisions that led to the Great Japanese Bubble were made. You see, after the Plaza Accord and the consequent devaluation of the dollar, the alarm went off amongst the Japanese authorities and the large industrial groups in the country. Wouldn't the loss of 50% of the value of the dollar in just a few months be a serious problem for the competitiveness of the Japanese industry? Well, to try to deal with this situation and avoid the risk of crisis, the government and the Central Bank of Japan basically decided to do 2 things: to boost domestic demand, that is consumption, and to implement an expansive monetary policy that would try to compensate for the effects of the Plaza Accord. In this way, in the following 2 years, interest rates were reduced by 50%. The government significantly increased public spending, and Japanese banks, encouraged by the country's own authorities, began to lend enormous amounts of money to families and companies so that they could launch themselves into the real estate and capital markets. Obviously, this policy caused the prices of real estate assets to start rising steeply, which in turn increased their value as collateral, and therefore the ability of families and businesses to borrow more and more. And just like that, the vicious spiral of the real estate bubble had been set in motion. What's more, don't forget that Japan had been characterized as a country of savers. In fact, in 1985, it was already the world's largest creditor. Well, with the fall in fixed income yields as a result of the new monetary policy, Japanese savers began to direct more funds to the stock market and the real estate market, which further fed the bubble. But these were not the only causes, nor the only ones responsible for the huge Japanese bubble. There is at least one other key catalyst for understanding how such a catastrophic balloon was inflated. A catalyst that has a lot to do with the stock market. Have you ever heard of Zytec? Listen up.
The business of speculation.
Between 1985 and 1989, Japan experienced enormous prosperity, at least it appeared that way. The average price of housing increased by more than 300% in that period, and during these years, the Nikkei Stock Exchange Index tripled its value to reach 39,000 points. It represented 1/3 of the world's total market capitalization. Well, the fact is that a financial engineering technique known as Zytec had a lot to do with this whole process. You see, taking advantage of the low interest rates, the big Japanese conglomerates began to take out large loans to finance the purchase of shares and real estate, something that allowed them to fatten their bottom lines. Why? Because at the time, accounting standards allowed these companies to present capital gains as income. So, the more shares were revalued, the greater the benefits. In other words, the more money companies borrowed and the more shares they bought, the higher the share price rose, which in turn increased the company's profits, and the cycle started over. With higher profits, they had more capacity to borrow, and so on, again and again. To give you an idea, more than half of the companies listed on the Tokyo Stock Exchange were involved in this system. In 1988, 38% of Toyota's profits, 65% of Nissan's profits, and 63% of Sony's profits were generated by this activity. And don't think they were isolated cases, no, not at all. It is estimated that by the end of the 1980s, between 40 and 50% of the corporate profits of all the major Japanese companies were generated using this financial technique. A technique that produced increasingly higher and higher valuations. To make matters worse, all this was happening while many companies' core business was not doing particularly well. After the Plaza Accord and the consequent revaluation of the yen, the operating margins of the large Japanese companies that were more oriented towards exports narrowed considerably. That is, Japanese companies were increasingly in debt and their activities were becoming less profitable. But despite this, their profits were growing and growing thanks to Zytek. It was an unsustainable situation.
The peak of the bubble.
The veracity with which the company's share prices were rising and the rapid increase in the value of the real estate market caused a widespread feeling of wealth.
It was a surreal world, as if money was dripping from the trees. Overnight, the Japanese person who owned a plot of land became rich without doing anything. Tag Murphy, banker.
The assets of the Japanese just kept growing at full speed. These were the years when Japanese tourists, camera in hand, filled the luxury stores of the world's major cities. And no wonder. In 1990, it was estimated that the Japanese real estate sector as a whole was worth 5 times more than the entire US real estate market. The estimated value of Japanese golf courses alone was over $500 billion. There were even some calculations that warned that the sale of an imperial palace in downtown Tokyo alone would have been enough to buy all the real estate in California. For its part, the stock market was also breaking record after record. The Nikkei index rose from 11,542 points in December 1984 to almost 39,000 points in December 1989. We're talking about an annual revaluation of almost 30%. That must have been quite a party.
January 2nd, 1990. The Japanese stock market generates 2 types of investors, the believers and the skeptics. Believers are getting rich. The skeptics are suffering. Just when the market seems overvalued, it doesn't stop rising. Marcus W. Brauchley, journalist at the Wall Street Journal.
According to data from the International Monetary Fund, in 1989, Japanese stocks were trading at a PER, at a price-earnings ratio of more than 60, while the US and UK stock exchanges were trading at a PER of 15 and 12 respectively. Of course, as is always the case, there was no lack of arguments to support these figures. In this case, there were 3 main explanations. Firstly, Japanese economy, which is closely linked to technology, had greater growth potential. Second, that the profits of Japanese companies were growing much faster than their peers in the United States and Europe, and thirdly, that the balance sheets of Japanese companies concealed significant capital gains in their real estate. Of course, in 1989, with companies quoting PERs above 60, the justification seemed increasingly difficult to swallow. And in fact, in that same year, the Japanese authorities began to see the writing on the wall. The company debt kept growing and growing, while their competitiveness was deteriorating at full speed. Inflation was at risk of skyrocketing, and the housing market was already completely inaccessible to young people. Faced with such a scenario, they tried to make a gradual descent, but things had already gone too far. When the central bank began to slow down the expansionary monetary policy, everything simple fell apart. And just like that, the bubble burst. In just 2 years, the Tokyo Stock Exchange fell by more than 60%. Corporate profits plummeted. Zytek was operating in reverse. Not only was it not adding value, but subtracting it. Real estate prices also suffered a very hard adjustment, and both banks and large companies faced serious liquidity and solvency problems. The bubble had burst, and taken with it the entire prosperity of the Japanese economy. Today, 30 years later, many economic problems derived from this process are still being worked through, and the Nikkei index sits at around 23,000 points, 40% below the historical peaks it reached 30 years ago. In short, this is the story of how Japan experienced one of the wildest financial bubbles of all time during the second half of the 1980s. The question we can now ask is, do you think we can draw any lessons from this whole experience? Leave your answers in the comments. So, I really hope you enjoyed this video. Please hit like if you did, and don't forget to subscribe for brand new videos. Don't forget to check out our friends at the Reconsider Media podcast. They provided the vocals in this episode that were not mine. Also, the channel is possible because of Patreon and our patrons on that platform. Please consider joining them and supporting our mission of providing independent political coverage. And as always, I'll be seeing you in the next video.